We are honored to have with us Dr. Ajit Ranade, Group Executive President and Chief Economist, Aditya Birla Group, as the keynote speaker of the conclave. Dr. Ranade is a member of apex committees of industry chambers, such as CII and FICCI. He is a co-author of the recently published book, Rising to the China Challenge 2021. He writes regularly in the business papers on economic issues. He is also a co-founder and trustee of Association for Democratic Reforms, a citizens watchdog organization engaged on electoral and political reforms. Dr. Ranade is an engineer, a management graduate, and received his PhD in economics from Brown University, USA. He received the Distinguished Alumnus Award from IIT Bombay in 2009 and Scholar of the Year Award from Wadia Trust in 2010. He's one of the top professionals in the area of finance. Sir, we request you to address the gathering.
Thank you. Thank you for the very kind introduction, Riddhi. Good morning to all of you, and congratulations on the conclave. I thank KIIT School of Management, the director, especially Dean Professor S.N. Mishra, who is also a friend, and his colleagues to invite me today to be with you and share my thoughts with you. And I congratulate you for various achievements of the school, which I've been following. I was fortunate actually to visit KSOM, I think about 5 years ago, and was very happy and impressed to see the facilities and the students. Of course, this was a time before the pandemic, so it was a very different time, very vibrant. And I hope all of you are keeping safe, and we will get back to the vibrant campus feeling very soon. So today the topic is on the financial sector. Riddhi, you can hear me? The sound volume is okay? You can.
Yes, sir, you're perfectly audible.
Thank you. Thank you. So today the topic is on the financial sector, and I want to share some thoughts, and possibly towards the end, if there is some time, it would be good if we can have some interaction briefly. So to begin with, the financial sector is basically an intermediate sector. So the financial sector, which typically in our minds consists of banking, the banking sector, the capital markets, which is the stock market, the bond markets, and also the insurance sector, which is life insurance, non-life insurance, health insurance. So together we call it the financial sector. But what does the financial sector do? Well, it connects two major parts of the economy. See, economic growth and economic development is increase in national income, increase in GDP, increase in employment, increase in jobs for young people like you. The GDP increases because we keep investing, as I think Professor Mishra just mentioned, investment. So when you build new businesses, new factories, when you expand in new highways, airports, this is all investment. Of course, GDP also is increases when you have consumption spending. So investment requires substantial funding. Typically, if you want to build a bridge, the bridge will last for 50 years or even longer, but it requires substantial investment today. If you want to build a solar energy plant, solar energy, which is going to give you almost free electricity because of because solar source, you need to do the capex, as Professor Mishra said, capital expenditure today, and that requires substantial funding. And industrialists, entrepreneurs, business people, they do that. But where does that funding come from? Some of it comes from their own funds, which we call equity, but a large part of it, the bulk of it, comes to the financial sector, which is basically in India, in the Indian context, we are a banking dominated sector. So it comes from banking. Now, where do the banks get the money from? The banks get the money from people like you and me who put our earnings or our income, we do some savings, right? So the bank depositors are the source of funding. and the industrialists, entrepreneurs, business people are the user of this savings. So what I'm trying to say, and the same principle applies for the stock market also. The investors the savers, they take their savings and some of the money goes into the stock market. And that money in turn is used by the companies for future expansion. And the same thing is true for insurance. We buy insurance policies to protect us from risks, or we buy life insurance. But that money which sits with insurance companies, and one of the largest, as you know, life insurance company in the country is LIC. I think that the total amount of investable funds available with LIC today is something like 40 lakh crores, 40 trillion rupees, or maybe 45 trillion rupees. That's the funding available for investors, business people, industrialists, entrepreneurs. So to begin with, my short point is that the financial sector just intermediates or connects savers to investors. I'm using the word investors in the economic sense of the word and not like stock market investors or like speculators. Investment spending, the spending which goes on new factories, new infrastructure. In economics, the word used is investment spending or investors. So connecting savers to investors is the primary role of the financial sector. Okay, so that's the first point. So we are examining how has the financial sector developed or how is it evolving. Now, there has been a thinking, going back to Schumpeter, a well-known economist back in the early 1900s, who believed the thinking then was that when the economy grows, the financial sector develops. Okay? So as the economic growth happens, as people's income rises, as industrial production rises, the financial sector will automatically evolve. The products will become more sophisticated, the services will become more. So this was the thinking for quite some time, by the way, that the financial sector, there's a British economist, a friend of India, and I guess one of the probably the most prominent woman economist of the past century. Her name was Joan Robinson. She said, where enterprise goes, finance follows, or enterprise leads, finance follows. What she meant is entrepreneurs, enterprising people, investment, business people, they start expanding activity and automatically financiers come and want to finance them. So if you are a startup, in the modern language, if you are a startup and you come with some great ideas, then bankers will rush to you. The funds will follow. Now, this was the thinking which was earlier in the, as I said, 1900s, 1960s also, maybe early 1970s. But that started changing. Ulta, it became ulta. That the thinking said, no, the economic development first, financial sector next. No, it is the other way. That financial sector should deepen first, should develop first, and then that helps economic development. That helps economic growth. So if you make the financial sector more sophisticated, for example, before 1994, we did not have an electronic stock exchange. Now we take it for granted. We did not have electronic banking. We did not have internet banking. We did not have digital banking. So all these developments in the financial sector, or fancy financial products like derivatives or credit default swaps. These are all, of course, technical concepts, but we didn't have that earlier. So the thinking from the 1980s was that if you have a fancy, sophisticated financial sector, then that in turn will cause economy to grow well. Okay, and actually the evidence started mounting for that in the 1990s. It became more and more accepted that the earlier thinking of 1960s, that first the economy has to expand, then only you should develop your financial sector. Now the thinking is the other way, that you need to develop your financial sector. You need to make it more sophisticated, and it will help economic growth. Remember, the role of finance is simply to connect savers to investors and help economy grow. That way, the financial sector is supposed to be a handmaiden to the larger cause of economic growth. But now, since 1990s, and I must say there is a influential paper by our own former governor Raghuram Rajan and his co-author Luigi Zingales. I think the paper is from I think about 20 years ago. That they studied industrial development, industrial sectors across the world, and they showed that in many countries, industrial sectors were able to expand much more or make more technological advance when the financial sector was larger. So they also, their research also supported the view that finance leads, industry follows. Okay. Now, with that background, we jump forward to 2008. So I'm just giving a little bit of historic background, just to tell you where we are in the journey of the evolution of financial sector. We jump to 2008, and you know what happened in 2008. And I mean, I'm sure all of you are very young people, but you've read up on the great financial crisis of 2008. That in September 2008, one of the most respected gold-plated investment bank called Lehman Bank or Lehman Brothers, it went bankrupt just overnight, just crashed. It's called the Lehman crash. There was a risk that half of Wall Street would just crash. So AIG, the world's leading insurance company, then Bear Stearns, even other big companies, they were on the brink of default. In fact, Lehman Brothers doesn't exist anymore. 200-year-old institution is gone, kaput. So because of that, on September 15th, I think, in 2008, the US Congress, what we call in our country the Lok Sabha or Parliament, in the US it's called the Congress. The US Congress had an emergency meeting and they approved an emergency fiscal bailout. It's called the TARP, Troubled Asset Research Program, or what we would call, in the pandemic time, we are in now 2021, we had a Atmanirbhar Bharat package announced by the Honorable Prime Minister last year in May. But basically this in 2008 was something similar, emergency rescue package. $700 billion was approved by their parliament or their Congress without even much discussion or debate. And that money was then used to rescue the remaining. So Lehman was gone, other rescue were done, and some emergency funding was infused into the financial sector. And subsequently, of course, we have seen the evolution. We can talk about that separately. Now, what had happened is till 2008, what had happened is that the financial sector had grown 6 times faster than the US economy. Economic growth, let's say if economic growth is 2%, the financial sector had grown at 12 or 13%. At one time, just before 2008 crash, 50% of all the entire profits of the corporate sector. The corporate sector includes manufacturing companies like GM, Ford, or oil companies, and the financial companies. If you take the entire corporate profits in the US, 50% was going to the financial sector, to banks, investment banking, and so on. In fact, if you had, forget about just having an MBA, I'm sure all of you are MBA students, but if you had a degree in mathematics, people who had PhD in mathematics, PhD in physics, engineering PhD, they were all being absorbed and sucked by Wall Street. I think that's happening even today after 13 years. So this was having a great impact on society, not just the economy, but society. The top talent was just going to Wall Street. If you ask a young person, what do you want to be? Investment banker. If you ask the person, do you know what is investment banking? How is it different from commercial banking? Half the people can't tell the difference. But I'm just saying that the financial sector was growing 6 times faster. And then we had the crash. So after 2008, again, there's been a rethinking. Is it that should the financial sector grow at a pace which is somewhat more reasonable and moderated compared to the economy? Is the economy more important or the financial sector more important? So we're back to that kind of thinking. And of course, 13 years later or 12 years later, we had another big crisis, which is the pandemic, right? That is not caused by, of course, it's not caused by the failure of a financial sector organization or a bank, but that is suddenly, economic activity has stopped. And but look at what has happened during this time. The stock market has grown by, I don't know, in last 12 months in India, at least at some 50% perhaps. The stock market in the US is such that the top 5 companies in the stock market there have more value. The valuation is more than the bottom 282 companies. This is in the S&P 500. Like in India, we have the Sensex, which is an index of 30 stocks. In the US, the most popular index used is not the Dow Jones index, which is 30, which is also 30 stocks, but the S&P 500. The stock market, has zoomed so much that the value of the top 5 companies is more than the bottom 282 companies, and it's growing every day. I'm sure you read about Tesla, Elon Musk, or Amazon, or Apple. So have we learned the lessons of the financial sector? I mean, let me spend the next 3-4 minutes in explaining how what's happening to the stock market. I mean, this year India has been fortunate to have something like 33 unicorns, that is companies with a valuation of more than $1 billion or almost 8,000 crores. And then some of them are getting listed, like companies like Zomato or Nykaa, and a couple of days back, Paytm. So what happens is that if an IPO is coming up, initial public offering, the stock is going to be listed. So if you have, let's say, if you're a high net worth individual and you have, let's say, 1 lakh rupees with you, okay, you go to the bank and you tell them, I need 99 lakhs from you. Why? I need IPO financing. So together, 99 plus 1, I will invest 100 lakh rupees in this Zomato. There is a wonderful company called Zomato, which is coming up for listing. I want to invest in this IPO. I have 1 lakh rupees savings, but I want to invest 100 lakhs because I'm told that there's so much oversubscription. And indeed, the Zomato was raising something like 9,000 crores or 8,000 crores of IPO. The actual money which was invested in the IPO was 3.8 trillion, 3.8 lakh crores. So how did that happen? Because financing. We are back, we're talking about the financial sector. So because of the oversubscription, almost 40%. So for every 1 rupee of IPO, 40 rupees was being invested, bidding was going on. So everybody got an allocation of barely 2.5%. So I go to the bank and I invest 100 lakh rupees, 100 lakh invest in the IPO, but I get only 2.5 lakh worth of 2.5 lakh worth of shares. So I repay the remaining money. I repay to the bank. All this happens in 15 days, by the way. Then I pay interest for 15 days, which is only 6 or 7% because interest rates are low right now. So net of, after paying interest, after returning the money to the bank, how much money is left with me? I got, remember, 2.5 lakh worth of shares. And half a lakh is all my expenses for 50. So I'm left with 2 lakhs. So in 15 days, I brought 1 lakh rupees of my funds. After 15 days, I have 2 lakh rupees. How did that happen? Financial sector, financing. So this is called IPO financing, and it's called leveraging. And this has been going on, So in fact, the RBI is now worried. So this can have implications. So of course, my talk is not about Zomato. I mean, I'm just using it as an example. But the Reserve Bank of India, which is the regulator, has got worried about this. And therefore, now they have put a cap on how much you can leverage. A person with 1 lakh rupees cannot come to the bank and ask for 99 lakh rupees of loans. You know why the banks are willing to give you a loan? Because it is fully collateralized. It is loan against shares. So the 100 lakhs that you invest is all against Zomato shares. And if you don't repay, those shares remain with the bank, they'll just sell it off. In fact, by the way, Zomato made on debut, the stock went up by 60%. The Nykaa stock went up by 80% on the first day itself. So the bank actually makes a profit. The bank gives you 99 lakh or 100 lakh rupees. On the first day itself, the stock is worth 160 lakhs. So the bank will make a profit. So bank is happy to give you a loan. The same thing was going on in the US before 2008. They were called ninja loans, NINJA. No income, no asset, no job. So people were being given loans for housing when they had no loan, no income, no asset. And the bank was happy to give you a loan against your house, 100%. And if you miss your EMI in the first month, second month, third month, they will repossess your house and they will sell the house in the market. And by then the housing prices have gone up. So the bank actually makes a profit. And in the US, unlike in India, defaulting on your housing loan is not considered to be a matter of stigma. So this housing loan, the 2008 crisis was basically a mortgage crisis. It started with the crash of housing prices. From 2003 onwards, housing prices was just going up and up and up and up. Just like what the stock market is doing now, it was a question of the housing bubble. So it was kept on going. So the banks were happy to participate. Banks were giving loans left and right. And the loans were getting profitable because they were loan against property and the property prices were going up. The people were happily taking the loans, but they didn't mind defaulting because they had no income. In those 3 months, they enjoyed the property. It went back to the bank, repossession, default, sale in the open market, make a profit, fresh loans. This continued for many years, and one day the party stopped. One day the bubble burst. So now the lesson for us is that Reserve Bank of India has now clamped down, has now said that no more IPO financing like this. You should have moderate leverage. But if you moderate leverage, then you're strangling the neck of financial sector. The financial sector guy says, no, we are doing innovative things. Now we are introducing crypto. I don't know how many of you are investing in cryptocurrencies. So you can invest as small amount as 1,000 or 2,000 rupees. Crypto is the new asset. So this is the struggle that keeps on going between innovation, sophistication, new products and services, and the caution from the regulator of being not leading to bubble-like situation, not leading. And just a few days, we've seen that the Paytm IPO, the first time we have seen that the IPO actually on the very first day, instead of the prices going up, it went down by 27%, which was a loss of investor wealth of 38,000 crores. In just one day, 38,000 crores worth of wealth was destroyed. And now there is concern. I'm told that even the stock market regulator, like Reserve Bank of India is the regulator for banks. The stock market regulator is SEBI, Securities and Exchange Board of India. They are now investigating whether investment bankers who are responsible for the issue of the IPO, whether they were misleading retail investors. Because after listening to all the great publicity and great write-up about Paytm, a lot of retail investors must have put money. Like I said, I have 1 lakh rupees of my savings, hard-earned savings. Instead of putting in a bank, let me put it in this IPO. And at the end of 24 hours, after investing after 15 days, I find my 1 lakh rupees has come down to 67. It's down 27%. It's down to 73,000. I've lost 27,000 rupees. So, for me, that is big money, right? Small investors. So retail investors. So who is to be blamed? You can't, this is the market forces. This is why the financial sector needs regulation. So let me just retrace back. I began by saying that in the modern times, people like Schumpeter, Joan Robinson, and other economists believed that the economy has to grow, and then the financial sector development happens, the deepening happens. But in the 1980s, especially in the 1990s, many researchers said, no, the financial sector needs to develop and automatically economic growth will happen. And that thinking was popular until we had the 2008 crisis. So now it's like a pendulum, There's debate on both sides. There are people who believe that the financial sector needs further developing. See, in India's case, India's savings rate is roughly 30% of GDP. Our GDP is about $3 trillion today, or after pandemic, maybe about 200 trillion rupees, 200 lakh crore rupees. 30% of that, so 30% of 3 trillion is $900 billion, or 30% of 200 trillion rupees is 60 trillion rupees, 60 lakh crores. So that is our annual savings. That's the amount of potential funds that can go into building new factories, new infrastructure, new schools, new economic activity. But unfortunately for us, half of it goes into non-financial sector. That has been the bane of India. It goes into buying real estate or gold. So all that happens is the real estate prices go up. That's not productive. When I sell a piece of real estate to you, GDP does not grow up. GDP does not go just simply by change of hands of assets. If I buy a gold coin, that doesn't increase GDP. So half of our annual savings, national savings, goes into the non-financial sector. The remaining half goes into the financial sector. Actually, that trend has actually gotten worse. I'm told it's gone down to not 50%, but 45, 47%. So more than half is in non-financial sector. So we as a country want our financial sector to deepen. We want it to deepen. We want more and more savings should go into the financial sector. People should put their money in mutual funds, in banks, in fixed deposits, in insurance, in pensions funds. They should not just lock up their money in buying a piece of real estate. Okay, which will go, but such is the state of development of our country that it's going to take some time. Other countries, developed countries, the ratio is much more, maybe 80, 90, 95% goes into savings. So a typical household in the US, their wealth will lie in all financial assets. So that's the direction we want to go, but we want to temper this journey in a way where we don't let the financial sector go out of control and land up in bubble-like phenomenon, what happened in 2008 in the US. And incidentally, 2008 was not the unique bubble bursting. It was very big, but we have had a series of such financial shocks. There was a I don't know if you read, there was a East Asian crisis, which was in 1997. There was the Argentino peso crisis. It was a currency crisis, not a banking crisis. But we've had episodes of banking crisis. If you look at our own history of last say 7-8 years, the non-performing asset ratio has been rising since it went up all the way up to 10%, 10-11%. And then during the pandemic year, the Reserve Bank of India gave some relief and gave some moratorium, saying that we will not, loans need not be repaid for 12 months. We can have a moratorium at least on the EMIs. And therefore, the NPA ratio has now somewhat improved. But again, we need to be careful. So the NPA ratio going up means the bad loans are increasing. Now, thankfully, we have some things now in place which will address this problem. So we had the creation of the bad bank, or what is called the National Asset Reconstruction Limited, government-backed company, which was set up, which will take all the bad loans from the commercial banking sector, and then so that the banking balance sheets are cleaned up, and therefore they can make fresh loans, and the NPA ratio will come down. So this is a new development. That's the banking reforms, and it was actually pending for many years. And hopefully, going ahead as the economy starts recovering, we will see more sort of healthy growth in the financial sector. That is the bank balance sheets, loans, healthy loans, and also the other aspects of the financial sector. So what I'd like to do now is give you one or two other examples, because the topic also talks about disruptive changes. See, one of the disruptive changes has been the growth of digital banking, the growth of, say, UPI. I don't know how many of you use Google Pay or Phone Pay. I'll be surprised if not, I'll be surprised even if a single person has not used Google Pay or Phone Pay among the younger people. But it's a disruptive change, right? What happened is a few years ago, the Reserve Bank of India gave licenses to new class of banks, new category of banks called payment banks. See, the Reserve Bank of India is the regulator for and licensor of banking. So there are the usual old style commercial banks, but now about 4 or 5 years ago, they gave a new set of licenses to payment banks. I'm sure you heard of Airtel Payment Bank, or Paytm also has a payment banking license. So what does a payment bank do? The payment bank allows you to make payments, right? So if a person X wants to transfer some money to Y, the payment bank gives you using your net banking, electronic banking, or mobile. But the conditions that were used, that were imposed on payment banks were they were not allowed to they were not allowed to make any loan. See, what is the fundamental business of a bank? The fundamental business of a bank is to accept deposits from savers like you and me, and then make loans to industry and business and entrepreneurs. And they make, by charging interest on the loan, they make a profit. Out of that profit, they pay you interest on your fixed deposit. It's very low, I know. I mean, compared to, in fact, nowadays the FD rates are very low. And that's how banks make a profit. That's how they're able to survive and sustain. That's how they do innovation. But payment banks were not allowed to make any profit. That was the rule. That was the condition of the license. And they could accept 1 lakh rupee deposits, I think. And they, out of that, all the entire deposits were supposed to be invested only in government securities. So no loan is allowed. So what happened basically is that the business model of a payment bank was that they could charge a fee for transferring, for making payments from when a person X makes a payment to person Y, they can charge a fee of, let's say, 10 paisa or 50 paisa for 100 rupees or 50 paisa for 1000 rupees. And that's the way they were supposed to survive. Guess what happened? Within a few years of the license being given, we had the phenomenon of Google Pay or Phone Pay or UPI based apps. What do? It's free. Google Pay allows you to transfer payment even as small as 5 rupees or 10 rupee payment for free. You can pay your newspaper wala, you can pay your istri wala, the person who irons your clothes, you can pay for vegetables, you can pay for so many things. When a person, you go together to the canteen, cafeteria, you buy two sandwiches, and your friend pays off the bill. He says, okay, I'll pay you 100 rupee bill, I'll pay you 50 rupees, I'll Google pay you. So the payment system innovation is such disruptive change that it's free. So now the payment banks are in trouble because the only source of income they could make is by charging a fee, and that fee has gone down to 0. So that's an example of disruptive change. So what has happened is that, of course, UPI-based transactions in the country, in the economy have zoomed. Last year, it was about 1 billion transactions a month. We are already then it went to 2 billion. And in October, I'm told there were 4 billion transactions. So number of transactions on UPI-based apps like Google Pay or Phone Pay and others have zoomed like anything. So at the same time, the cash in circulation in the economy is also rising. So today, the economy has something like 29 lakh crores of cash circulating. And it is 57% more than pre-demonetization. But UPI-based payment systems are also zooming. So what has happened is the other payment systems which came in, like the payment banks or prepaid wallets. I don't know if you ever used wallets like Ola Pay or I don't know if Zomato Pay, something. These are all wallets. So you could store some money and or Amazon Pay or something. And from that wallet, you make a payment. But those wallets are now going. People are preferring to do Google Pay, which is directly from your bank account. You don't need to have a wallet. So actually, the increase in UPI-based transaction is taking the market share away from prepaid wallets. It has not been able to reduce the cash in circulation. We think we are going towards a cashless society. I think that will take some time, obviously, but hopefully if not cashless, we will reach towards a less cash society. But certainly, so this is an example where the disruptive change of payment systems using UPI has really shaken up now the payment bank license. Now the worry is that these banks which had got payment bank licenses from RBI, will they survive or not? In fact, 10 banking licenses were given. Five companies surrendered back. They said we cannot do any profit based on these RBI conditions. RBI itself is looking at whether they should relax the conditions of the license so that the banks can at least survive. So they can at least survive the competition against UPI-based transactions. Incidentally, UPI is also a monopoly. Unified Payment Interface, UPI-based clearing, UPI transactions, the backbone is handled by one company called National Payment Corporation of India, NPCI, and it's a monopoly. So now the RBI is saying maybe we should have one more player so that there's competition. Just like before 1994, we had only one exchange in the country called Bombay Stock Exchange. It was a monopoly. Then we introduced a new exchange called National Stock Exchange, NSE. And people said, how can you have two stock exchanges in the same country? And guess what? Many years later, now we have one more, or two or three others. So stocks can be traded in other stock exchanges also. Similarly, in UPI, the UPI monopoly of NPCI perhaps will go after a new corporation is also allowed to do UPI-based clearing, UPI type of clearing. So these are, there are disruptions in payment. That's an example of disruption in payment systems. I'll give you another disruption which is coming from fintech companies. This is on lending. Remember, the fundamental job of a bank, the fundamental business of a bank is to make loans. When you make profit on the loan, you make sure the loan is recovered, it doesn't go bad. And from the profit, you pay your depositors. And then, of course, you do innovation and you pay salaries and so on. Now, typically, the loan appraisal was done on the basis of, you make a loan application and then you provide some collateral. So lending, conventional lending is to be based on collateralized against collaterals or your income statement or some income projection. You show that you have income. All that is changing now. In the fintech world, now they are able to give you a loan based on your digital trail. They will say, show me your electricity bills for last 12 months. Or they will not even share. They'll say, just share your Facebook account. So we will know on which day you are watching a movie, or I don't know, they're using AI tools, artificial intelligence tools. So they actually, by trawling, 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 not trolling, trawling, TRAWLING, by trawling social media, your Twitter profile, your Facebook account, or by accessing your digital trail, by looking at your CIBIL score, they're able to give you a loan without even collateral. And that's a disruption. It is already a big industry in China, I think other countries, and India, it's also coming. In fact, there are many of the startups, the exciting thing about startups, and many startups are in fintech, is because they are using all this digital modes to have innovative ways of doing loan appraisals and instant loans. You're promised a loan within one day. Again, using digital. This is another second example of disruption is going to come in lending. There are now banks. There is a bank in Korea, I think, which is purely digital. They have no branches. It is pure digital bank. There is no branch. You can't go and walk to a branch. There is very little paperwork. Everything is digital. There are now, the distinction between retail bank and a grocery store is getting blurred. When you go to a grocery store in a large mall, if you're buying, say, from Reliance Fresh or More or DMart, you will see there are these kiosks, ATMs, or you will have a card issued by the grocery store, and you can use that to make payments. So you're wondering, am I in a bank or in a grocery store? And the converse is also true. There used to be bank branches where they started having a coffee shop. So you think, am I in a bank branch or am I coffee? Because they want you to browse through other services, mutual funds, insurance, wealth management, wealth banking. So the evolution in banking is happening, and technology is really disrupting. But I just want to make a few concluding remarks on this, that because I've not even gone into crypto, the new asset classes of investing in crypto, the exciting and perhaps scary thing about crypto is that crypto as a currency actually does not depend on any central monetary authority. So it does not require a central bank to issue that currency. So people can buy and sell cryptos, can invest, can in fact use it for payments, and there is no central authority responsible for creating money supply. See, the whole purpose and foundation of monetary policy is there is a central bank which creates money supply. If there is a lot of supply, that leads to inflation. If it's contraction of supply, it reduces inflation, and they can control interest rates. The crypto world just completely, undermines this. That's why there is discomfort. Some countries are thinking of banning crypto. In India also, there's a lot of debate. So far, it is not illegal. And if you look at some of the front page newspaper ads in the last couple of months, they're all crypto advertisements. I don't know if you've watched IPL, the cricket matches. Who are the main sponsors? So the crypto world is also exploding in India, and policymakers are watching, parliament people are watching, so that's the new disruptive trend in the financial sector. So let me, as I said, my concluding remarks is the following. We have to remember, number one, that the financial sector is an intermediary. It plays a role of connecting savings to investors. Economic growth happens when the aggregate pool of savings is deployed into productive investments in the country. Second, whether finance causes growth or growth causes finance is an open debate. It was believed that it is economic growth which comes first and the financial sector develops and becomes more sophisticated. But the contrary view also has been around. And after the 2008 crisis, it's still an open debate. It needs to be regulated, and we need to avoid bubble kind of phenomenon. Number three, various conventional models are getting disrupted, whether it's banking or stock markets or investments, or I would say even insurance. It's getting disrupted all the time. And the main reason for disruption is digital. So we need to understand this phenomenon of increasing digital penetration in every aspect of the economy, including the financial sector. The last point I want to conclude also is to remind you that financial sector is an exciting field, obviously, and students of management, I know that apart from consulting and startups, one of your favorite job market is to be in a financial sector company, preferably fintech or investment banking. But we also need to be aware that there is a phenomenon called increasing inequality, whether it in terms of access to financial services or access to stock market wealth inequality, or digital inequality. As we become very savvy with using digital tools, I'm quite comfortable making Google Pay payments. I'm quite comfortable switching my funds from mutual fund, debt fund to equity fund back and forth. I'm quite comfortable buying crypto, but it's a tiny fraction. We need to know how to bridge this widening inequality, income, wealth, access, and of course financial literacy. So as leaders of society, future leaders of society, I think you have a responsibility not only to become successful, of course, and help your friends, family, and your career, but also hopefully participate in the policy around how to keep the inequality in check. I'm not saying we can never go to zero inequality, and that's not even desirable probably, but how to keep it in check so that it doesn't disrupt national life and cause detrimental consequence to our society. So I thank you again for inviting me. I hope some of these thoughts have been useful to you, and I congratulate you on the conclave. And I'm happy to, if there are any few questions and time left for questions, I'm happy to take that. Thank you.
Thank you, sir. It was fascinating to listen to you on the subject. Students, by their very nature, are very inquisitive and they have a few questions. So with your kind permission, sir, can we take a few of them?
Of course, yeah.
I request the students to raise their hands, and as I call out your names, you can unmute yourself and pose your questions to our distinguished speakers.
Yeah, Shreya.
Yeah, Shreya.
Go ahead, Shreya.
Yes, sir. Good morning, sir.
Good morning.
So, my question is that as you elaborated about the fintech and the digitization of the financial services, so what are the implications in this current market structure, and what are the reforms in the policy for the policymakers?
No, fintech is the marriage of financial services with technology, and mainly the technology is digital. So from the policymakers, they just they want to reduce. The policymakers want to adopt a sandbox approach. They are allowing fintech to, for example, KYC norms. Know your customer. Now, a bank is not allowed to open a deposit account or even make a loan unless you fulfill your KYC. And in the earlier days, KYC, I don't know, you will probably, I don't know if you know this, but to open a bank account, the bank officer or somebody from the bank had to come to your residence or ask your neighbor, does she live here? Long ago, I mean, I'm talking about, but we have come to a point where you have instant KYC thanks to Aadhaar. But and even that, some people are saying, can we fast track? So the answer to your question is that what are the policies? So there's always policy which tries to make life easy for financial services companies using digital technology, but at the same time not make it so vulnerable that it can lead to abuse or some loss, fraud. So I've not in my talk talked about cybersecurity. There's a lot of hacking risks. People don't, sometimes you get OTP, it gives you only 20 seconds, it's not working, and somebody just calls you and, makes you believe I'm calling from the bank, please give me your OTP. So because of that, you have to always have a trade-off between how much to promote and how much to, be careful about the promotion. So I'll just call out the names. We'll go to Tanu Priya. You're on mute, Tanu.
Yes, sir. Sir, as before payment disruption in payment, you mentioned a thing that people should invest more rather than more option rather than is real estate. So one option you mentioned is fixed deposit. As we have seen in past this year, that fixed deposit is not giving that much benefit to the peoples. Rather, people are incurring losses. So what will be the future of investing in fixed deposits? Please shed light.
Thanks, Tanupriya. I did not say should or should not. I'm not saying people should not invest in real estate and people should. I was saying that is the evolution of our country. We are at a stage where almost 50% of our national savings, which is very precious, is going into unproductive usage like land, or real estate, or gold. Ideally, as a country develops, more and more fraction of our savings should go into the financial sector, which in turn leads to productive investments in new factories and new businesses. Now, you mentioned that when a person goes to a bank and tries to put their money in a fixed deposit, you are earning only about 3 or 4% for a 6-month or a 12-month deposit. But the rate of inflation today is 6%, 7, 8%. So you're actually earning a negative return. That is one of the reasons why people are going into the stock market. They said at least the stock market is rising faster, but it is full of risks. So the question here is what to do. Now, this is not an easy question to answer because the Reserve Bank of India should not keep interest rates so low. According to me, they should take care of the interests of depositors, not young people like you who don't mind taking risks, because even if you lose money in the stock market, tomorrow you'll get a great job. What about pensioners, people who are elderly? About 200 million people in the country are above the age of, maybe 55 or something, and they cannot afford to take stock market risk. They depend on pensioners depend on fixed deposits, and they are earning a negative return. So I think it's up to the policymakers to balance the competing interest of people who put money in fixed deposits as against people. But if you raise interest rates, that IPO financing example I gave you will not work, because it works because low interest rate allows you to borrow from the bank and invest heavily in your IPO. So they will be upset. So there will be a stock market lobby which will be against RBI saying, no, don't raise interest rates. A lot of the industry lobbies say, don't raise interest rates because it is detrimental to economic growth. So the regulator and policymakers have to compete these interests. Thank you. Let's go to Sparsh. You're on mute, Sparsh. I still can't hear you, Sparsh. No. I'll come back to you, Sparsh. I'll go to Ishan Rath.
Hello, sir. First of all, thank you for such a wonderful session so far. My question is related to normally the fintech platform, because everyone is very hopeful towards a future of fintech. But you're considering the fact that for recent days, Paytm IPOs received a far weaker response in comparison to other recent IPOs that witnessed a bumper stock market debut. The company's IPO saw a very weak response on the first 2 days and barely it's oversubscribed for the final day. So what's your views on it?
Which company?
I'm talking about Paytm, sir.
Okay, so I am not at all an equity analyst. I have zero knowledge about how to do analysis of companies. So I just took it as an example. I'm saying that this is investing in stock market as against putting your savings in the bank. There is a difference. The bank savings is considered to be safe, but nowadays even the bank can fail. As you know, what happened with Punjab and Maharashtra Cooperative Bank, or before that, Yes Bank and so on. So, but banks are considered to be safer, and stock market is risky. And the IPO financing game was going on, but now people who must have put heavy amount of money in Paytm, they found that on first day itself, they lost 27%. So my only illustration was that. So I really can't go into answering the question, what is Paytm is a very complex, big company, and I'm sure there's a lot written there. Thank you. Let's go to Karthik. Yeah.
Hello, sir. Thank you for the insightful speech. It was really great to hear you. I'll quickly ask my question. You mentioned about the monopoly of NPCI in the UPI segment, which RBI is taking into the cognizance. Am I audible?
Yes. Yeah.
Yeah. So my question is about the monopoly. We have studied that price is usually greater than the marginal cost, and the system turns out to be exploitative for the consumers in the short as well as in the long run. So I want to understand from you, in the current context, how is NPCI, given the situation, given the condition that it's basically more or less free of cost for the consumer. So how it can turn exploitative, or what is the reason for RBI considering?
Yeah, Karthik, I did not say that NPCI was exploitative, not yet anyway. I just said they're in monopoly. And one of the problems with the monopoly, as you yourself say, it could be exploitative, but that is not that is one concern. But the other concern is that a monopoly company typically stops innovating. Okay. So NPCI, for example, I would like to have, we have a lady who comes to go wash our utensils, household help. Now I pay, let's say we pay her 1,000 rupees every month as for that. So I would like to have NPCI, which can allow me to Google Pay feature, where I pay on first of every month 1,000 rupees to be paid to this Google Pay to this person for the next 12 months or next 6 months. I don't think NPCI is offering me that. Google Pay does not offer me that. So this is just one trivial example. There can be hundreds of examples where product innovation is not happening. If they had competition, the competition would have offered many products like this. I can think of so many different combinations. I would like to have one button. I would like to make 5 payments to 5 different people. but I have to go through the blah, 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 you know. So this is what financial sector innovation is all about, innovation in products and stuff. And when you have competition, they'll compete against each other to give new and new, you know, some ideas. Otherwise, if you're a monopoly, you will be complacent. Ek hi ek transaction hota rahega. Okay. So let's go to Ankita, please. And then maybe the last one or two questions. Go back to Sparsh. Yeah, Ankita.
Good afternoon, sir. I just want to ask you a question that, as you mentioned about that India's bane is that half of its savings goes to the non-financial sectors like gold and all. So is there any initiative taken by the financial sectors to attract its customer towards they should invest in them rather than investing in gold?
I think, Ankita, excellent question. Thank you. Now, there is one great famous gentleman called Amitabh Bachchan, right? You have heard of him? So he is a brand ambassador for a company called Kalyan Jewelers. Have you heard of Kalyan Jewelers? So I have been saying for many years, why don't we ask Mr. Amitabh Bachchan to be the brand ambassador for something called sovereign gold bond, SGB. This is demat gold. This is sold by banks and through RBI. This is an instrument which is a financial sector instrument. You invest 1,000 rupees or 5,000 rupees or whatever. It is an 8-year. The gold bond is valid for 8 years. Maturity date is 8 years. You will get the current price of gold. That means market price. So it is like investing in gold. Plus, you also get the advantage of exchange rate, because if the exchange rate in India depreciates, you get that advantage. Thirdly, it is tax-free, meaning no TDS is cut. And fourthly, on top of all this, they offer you 2.5% interest. But sovereign gold bond was, we have been discussing this with the finance ministry people for many years. I remember more than 5-6 years ago. It was introduced only in 2018, I think, or 2019. And have you invested, Ankita, in sovereign gold bond? No, because nobody has told you, because nobody has explained the attraction of it. So this is an example where I think the financial sector also should do more to educate you to financial literacy ke liye. How, in fact, investing in sovereign gold bond is just like investing in gold, but it gives you even better return, I would say. And investing in sovereign gold bond, which is a demat account, that money will go into the India's financial sector. That is not dead in. When I said half of our savings goes into financial sector, when you invest in sovereign gold bond issued by RBI, that is actually financial sector savings. But when you go and buy a jewelry from Kalyan Jeweler, I'm sorry, I have nothing against them. God bless them. But that is, just buying jewelry. So that is gold. I don't think it's as productive as building a new factory. So we'll take, I don't know, Dean Mishra, how much time we have. We'll take 2 questions, one from Sparsh and one from Akshay. We might run out of time. Yeah, Sparsh. You're on mute, Sparsh.
Can you hear me now, sir?
Yes.
Good afternoon, sir. Very good afternoon. So, sir, I just have a small question. Currently, the inflation rate is showing an increasing trend. Interest rates, while are also decreasing comparatively. Then, with real return on the investments for the banks itself are decreasing, sir. How will this trend affect the growth in the economy itself?
No. Real return for banks are not decreasing, Sparsh. The return for the bank is when bank gives out a loan, they are charging interest rates of 15%. If you're an SME person, first of all, getting a loan is difficult. But if you go and take a loan to build your new factory, that interest rate will be 15% or at least 12-13%. So as a fixed deposit, when you put your money in the bank, you are getting only 3-4%. And the bank is charging 12-13-14% for a loan. So the bank is getting a handsome return.
I was talking about the increase in NPS, sir, as you explained earlier, and how the increase in NPS.
The question is when the bank makes out a loan, they charge an interest of 14%, they get a good return. But unfortunately, some of the loans are turning bad. And unfortunately, 10 lakh crores out of 100 lakh crores, 10 lakh, so 10% of the loans have gone bad. Now, how to control bad loans, that is an old problem. Now, it used to be said that because some loans are made, there is outright fraud. You heard of this Mr. Choksi, Mehul Choksi? Have you heard of, let me not name all the other names. So those people just ran away, right? Modi, what is his name? Nirav Modi. So some cases are outright fraud. Some cases, I must say, the NPAs are because the business cycle downturn happened. If I was someone who had given a bank, invested in, let's say, a plant, a fossil fuel plant, which they say that it's going to decline with solar energy. So, today I think I read an announcement that the Reliance and Saudi Aramco deal has been called off. Maybe because, I don't know, I've not read it fully, but because the future of fossil fuels is not as bright as it used to be, because the whole world, we had this COP26 agreement that we want to phase out fossil fuel based energy and replace it with renewable energy like wind and solar. So if you invest, so that is an example where business downturn can happen. So for example, during the pandemic, all the restaurants, all the malls were shut. So any bank which has given a loan to them, that will turn an NPA. So NPA has various problems, but we have to have mechanisms where we can quickly resolve them, restructure them.
Thank you.
So maybe Akshay, we will go with the last question. Akshay. Mr. Akshay Sahu.
Yes, sir.
Yeah.
Thank you, sir. I want to ask the cryptocurrencies, how far it is safe, as there is no one to regulate the cryptocurrency.
So you are asking me how safe is it to invest in cryptocurrency? I have to tell Dean Professor Mishra next time to invite me as a stock market expert and crypto expert. So, because I'm not the right person to answer questions about which stock market, why is it going up or down. You need to understand how this cryptocurrency investment works. It's a blockchain-based technology. And it is, of course, I'm not saying it's not easy to understand, but it is worldwide. It's not just in India. JP Morgan, which is a very famous investment bank, their analysts are saying they expect the Bitcoin price to go up to $120,000 per coin. Right now, it's at 62,000. And not some time ago, it was just 30,000. There are people in India I know who have bought it when the price was only 1,000. They have made good money on it. But it's a very speculative instrument. And it's not for me to either advise or caution. I think you'll have to do your own research or go to an expert.
Okay. Thank you, sir.
Thank you. And thank you, everybody, for your patience. And I wish you all the best.
With your kind permission, Dr. Ranade, I have just one question from you.
Sure, sure.
You mentioned about disruptions. Now tell me, the government is also looking at increasing privatization of the public sector banks. They are trying to make a beginning. And there are many, as you know, who are very strongly batting for going back on nationalization, privatizing the public sector banks as a very important component of financial intermediation. Do you think that the disruption that is likely to be caused would be better? Or, what's your take on this, particularly the concerns regarding, the corporates taking over the banks, the licensing arrangements, So what is your take on this? Thank you.
For economic growth, we all aspire that Indian economy grow at, say, 8% or 9% on a sustained basis for next 10, 15, 20 years. That economic growth is not possible unless credit also grows at 15%. That means banking credit to industry, small and medium businesses, to startups, it should increase. The credit growth should be at least 15 to 18% per year. Today, the credit growth is hardly 8 or 9% or 7-5%. So credit has to grow at 15, 18%. Now, for the credit to grow, the bank balance sheet has to expand, which means that the bank, not only bank deposits have to grow up, but also the banking capital. For every 100 rupee loan that a bank makes, it has to set aside 12 to 15 rupees as risk capital, which is the capital adequacy norm. So if bank balance sheet is going to increase, then the banking capital also has to increase. My estimate is that in the next few years, Indian banking will need something like 5 trillion rupees, 5 lakh crores of fresh equity infusion. Now, if it is public sector banks, if 70% of banks are public sector and owned by the government of India, this fresh equity has to come from government. But government of India is under huge fiscal stress, fiscal challenge. So where will the money come from? So if you want the banking to grow and you need fresh infusion of equity, banking equity capital, either it will come from the corporate sector, which is sitting on a large pool of risk capital, or it will come from foreign. If you allow foreigners to come and own banks, right now, foreign ownership of bank is restricted. We do not allow 100% ownership of foreigners. Of course, you have branches. So HSBC, Citibank, or Standard Chartered, all these banks have branches in India. But they don't have FDI, they don't own the bank here. So they have to incorporate here and have. So either we have to allow foreign ownership of banks completely, or we have to allow corporate ownership of banks. Or we have to ask the government of India to put 5 trillion rupees more. They are struggling. They need more money for NREGA. They need more money to pay for pensions. They need to modernize defense. With the challenges on our northern border with China, we need to have much more modern. They need to invest in infrastructure. So that is the challenge. The answer to Professor Mishra's question is, this is the challenge that the policymakers will have to figure out. If we allow corporate sector to put their capital in banking, the fear, apprehension is that the corporates will do connected lending, that they will give loans to their friends, but that was the fear, I guess, in the 1960s or 69 or 70. Today, we have a much more sophisticated system of regulation. We have much more digital, sort of 360-degree view. And I think there are adequate measures which we can put in place, which we can ensure that the corporate sector does not abuse the license. In fact, if anything, we can ask the corporate, if a corporate sector sponsored bank is set up, then it should be ring-fenced. No other ownership and connection should be there. Incidentally, banks like IndusInd Bank have substantial investment from Hindujas, which is an industry house. Kotak Bank used to be actually Kotak Mahindra Bank, and that is investment from Mahindra, which is an industrial house. So I could give you other examples. I'm told that Bajaj, which is another industrial house, has 6-7% investment in ICICI Bank. So it's not as if there's not enough industrial corporate sector investment in banks, but this is a policy question. I mean, it is undoubtedly true that we need to expand balance sheet of banks to support good economic growth, and the country needs banking risk capital. Where is that risk capital going to come from is a question we need to answer. Thank you.